Now, when these lizard people start messing with your money, we got a problem on our hands. So let's start with this right here so you understand what's really going on.
And joining us next is Peter Schiff, the chief economist at Euro-Pacific Asset Management. He'll break down the factors behind the collapse of Silicon Valley Bank and some of the implications. Peter Schiff, thank you so much for joining us.
Oh, my pleasure.
Peter, Treasury Secretary Janet Yellen today testifying on the Hill, essentially saying in light of turbulence in the banking sector that the banking system's fine. I want to play you a soundbite here.
I can reassure the members of the committee that our banking system is sound and that Americans can feel confident that their deposits will be there when they need them.
Peter, should we feel confident in our banking system right now?
Not at all. In fact, that comment is as accurate as her earlier comments that inflation was transitory, or the comments back in the days of leading up to the 2008 financial crisis, when her and everybody else at the Fed was saying that not to worry about subprime because it was contained. Thanks to Janet Yellen, particularly what she did as Fed chair. She kept interest rates at zero for practically her entire term as Fed chairman. That's the reason that we had such a big bubble, those low interest rates and quantitative easing, and she was part of that. That's why all these banks are loaded up with now underwater long-term treasuries and mortgage-backed securities. So the banking system is a house of cards.
All right. Now that we've laid out what caused the banking crisis that America went through, it's important that you see for yourself what ended up coming out of it. You may be saying to yourself, Dog Waters, well, I don't get why we're talking about lizard people in banking. We're talking about green people in banking because these are the people who rule the world. And again, it don't matter how you see things from your perspective. If you want to know the truth, you go to the horse's mouth and see what the horse is saying his damn self. How many of y'all want to go to the horse's mouth with me? Raise your hand. Me, I want to go see the horse. Let's go to the horse's mouth and see what the horse is talking about.
We're going to talk about the global banking system with the right people. We're going to talk about whether banks are prepared for the future. We're going to talk a little bit about how banks are doing right now. So I'm very excited to introduce our distinguished panelists, Slawomir Krupa, did I say it right? CEO of Societe Generale, Geeta Gopinath, of course from the IMF, where she's the Deputy Managing Director. Sergio Armani is the CEO of UBS, and Mary Erdos is the CEO of Asset and Wealth Management at JP Morgan. So we've got a nice representation of the world and the industry, and 2023 was a weird one because it's hard to believe. Back in March, we had in the US bank failures, including Silicon Valley Bank. I mean, there was a lot of drama. We had that rush shotgun merger or acquisition between UBS and Credit Suisse. Sergio swooped in to the rescue. We had higher interest rates. We have 2 wars around the world. I mean, a lot of headwinds, and yet it feels like, Geeta, global banks aren't in terrible shape. How would you characterize it right now?
Yes, Sarah, I think the good news is that despite the very sharp increase in interest rates and the conflicts that we have seen, the global banking system has overall held up quite well. Now, that said, there is still a tail of weak banks that we see even now in the current environment. For instance, if you look at the US and if you look at the number of banks that are at risk, they make up about 9% of banking assets in the US. Now, another area of exposure that we do worry about is in terms of exposure to commercial real estate. And that is a bigger deal in the US, somewhat lesser so in Europe, but still true in Europe too. And the reason I'm mentioning the fact of these tail banks is because what the March episode taught us was that all it takes is a couple of mid-sized banks to get into trouble, that there's a very quick loss of confidence in the system as a whole. I mean, there was the risk of there being a systemic crisis and required very strong action by the Fed and by the Treasury. So this, I think we should keep in mind that even if the whole system as a looks in a good place, the tail can still wag the dog. If you look more globally, emerging markets, excluding China, have actually held up quite well. Their regulatory capitals have been quite high, and that has actually helped them tide over this difficult period. China, of course, is a different story of its own, which is it has banks, very large banking sector. I mean, the top 4 banks in the world are in China. But also they have the issue of the exposure to the property sector, which is weak, local government financing vehicles, which are in some trouble. So, China banks, I think there are issues that one needs to worry about, especially, again, among some of the smaller banks.
Then after we figure out what the horse is talking about, we'll come back with some conclusions. But off we go to the horse's mouth.
So the banks are a reflection of their clients. A bank is as strong as the type of clients it has and the relationships that it has with it. And it's a relationship business, and who you choose as your clients and how you do that, it shouldn't be a surprise as to what happens when you get in a stressed out situation. So Sergio's point about in the US, in the regional banking crisis, you had 90% of the clients of Silicon Valley Bank and First Republic Bank were institutional clients who were uninsured depositors who are now in a digital world. So in a digital world, you don't have to wait even until 8 in the morning. At midnight, you can say, out, I want those assets moved.
After a tweet.
And everything goes. And so it all comes down to regulation and stress testing and making sure that you're running a proper financial institution based on the clients you have and the likelihood that they are to do A or B. So JP Morgan Chase, incredibly blessed to have the clients that we have. We bank half the households in the United States of America. We bank 90% of the Fortune 500 clients. We share many clients with my colleagues on stage, and we're fortunate enough to work with clients where we say, we want to lend you money, but we want to do this in the right way. We don't want to do this in the wrong way. We want to have a relationship with you where we're there for not just one thing. Banking is not a commodity. It's like a doctor. You don't just pick and choose whatever is the cheapest doctor because you want help on a surgery. That's not how you think about it. You think about it for a very long-term health of your own body or your own company. And that's really what this is all coming down to. So it shouldn't have surprised anybody that the regulations of small and mid-sized banks in the US didn't even look like European banking regulations. They looked very different, which is why when we talk about what are the regulations that we should have going forward, they should just be sensible regulations that when you stress test the situation, and you have to stress test it for the modern world that we live in with instantaneous decision making, you can't think that people are going to stay around because they like you. And they like the relationship. They're going to act in their own best financial interest, and that's exactly what happened. And neither Sergio nor we at JP Morgan want to have to go through those crises weekends where we're being asked to take on a company, because it just means that the system is fragile. But thankfully, when you're a strong enough institution with a fortress balance sheet and the ability to do that, then at least somebody is there to be able to help.
Right, so let's get into regulation later, because I know you have some opinions about Basel III. But, so you both ended up, you ended up with Credit Suisse, you ended up with the First Republic. Were you surprised that the regulators let you acquire that? And it does feel like the big got bigger as a result of what happened in March. And I don't know if that's a good thing or not.
I don't think either of us would use the word let.
Let?
Yeah.
What? Forced?
We were asked.
Asked.
Well, you were forced.
Well, I wasn't there, but I guess it's fair to say that, and which was one lesson also out of the crisis, that you got into, in order to be asked to be part of a solution in addressing a crisis, you need to be credible and prepared. And the business model you pursue leading into that moment is very important. Because, in the last few years, we saw a lot of crises. You mentioned a few of them that we are facing or challenges. And it's nothing different than what we saw in the last 10, 20 years. So that's a constant.
Wait, did you hear that? Were they forced to do it, or were they asked to do it? Were they forced to do it, or were they asked to do it?
Well, first of all, the reason that the bank failed was because of the artificially low interest rate and QE environment that the bank operated in for a decade. It was the Federal Reserve that created all these distortions by its artificial suppression of interest rates, and it caused financial institutions to take incredible risk in order to get a return. And also, the U.S. government, through banking regulations, actually encouraged these banks, through favorable accounting, to load up on treasuries and mortgages because they didn't take a haircut on those assets like they would for other assets, nor were they required to mark them to market. So as they were losing value, they pretended they had no losses. And so this whole thing was a byproduct of bad monetary and fiscal policy. Cryptocurrency actually got started in response to the 2008 financial crisis and the fear that all the money printing would lead to inflation, which of course it has, and it's only getting started.
And that forcing created what? Consolidation of the banking industry. So what happens if every time there's a banking crisis, every time a bank fails, they're consolidated into a larger bank? And let's say exponentially these banking crises happen and they continue to get consolidated into larger banks. At the end of the day, ladies and gentlemen, how many big banks will be there? And how much control do they have over your money? And more importantly, you need to understand this. How much control do those big boys have over your entire economy? You see, it's not really hard to look at the list of people and see what they're doing. Manufacturing crises, taking advantage of the crises, consolidating power. Manufacture crises, consolidate, take over power. It's done through war. It's done through banking. It's done in the medical system. It's done in the crypto world. It's the same move over and over and over again. 44 dive right up the middle. Right off the right butt cheek of the center. We're running the ball straight up the middle, and we don't care who's in the way. We're running right over you like we Marshawn Lynch. And ladies and gentlemen, that's what they're doing you. That's what they're doing. They're running you right over like they Marshawn Lynch. But don't believe me. Don't listen to what I'm saying because I'm only the Stankonian and I know nothing. Let's see what else they got to say. You see? Are you hearing what the horse is saying out of his mouth? I'm serious. Are you hearing what they're saying to you? Because if you're hearing what's being said, then you come into the conclusion and understanding that, hold on, bro, something not right. And I need to be guarding my paper. You know what I'm saying? I need to be guarding my cheese. I need to be guarding my bread, my guacamole, my greenbacks from what's going on out here in these streets. Because all it takes is the big one. And your little regional bank gets shut down, your little small bank go away, and it gets bought up by one of the big banks. And your money is going kapoof. You understand? You see, the more of these do, the more of these I do, the less I'm going to talk. Because I need you to see what they're saying. Everybody else want to try and tell you, no, listen for your damn self and listen to what they're saying to you. Yeah. See y'all on the next video, baby.